I'm going to change what I invest in each month, and in this video I'll explain why, my thought process behind it, and the exact way I decide which fund to buy from the sea of options out there. I've always been a global index fund investor, and that's not changing anytime soon. But to understand what's shifting in my portfolio, we need some context. Jack Bogle launched the first retail index fund in 1976, a revolutionary idea at the time. The investment world called it Jack's Folly, even branding it un-American because of its low fees. Ironically, it was an all-American S&P 500 fund. It took years to catch on, but over the decades, passive investing has exploded in popularity. By 1992, Vanguard had launched what looked like a global fund, though it was really US-centric, holding American companies with global exposure. It wasn't until 2008 that the first true global fund appeared, and by 2012, global ETF like VWRL became accessible to UK investors. So why the quick history lesson? Because while our planet is billions of years old, global index funds are barely teenagers. The space is still evolving, and occasionally something new and interesting comes along. How I shop for index funds when it comes to investing, I treat it like shopping. Studies show that people who make shopping lists spend less, make fewer impulsive decisions, and feel more in control. The same principle applies to picking index funds. You need a checklist. Right now, UK investors can find nearly 470 global fund options on major platforms. But with that many choices, you need a clear process to filter them down. Here's what's on my shopping list for index funds. 1. It must be passive. I only invest in passive funds, not actively managed ones. The reason is simple. Active managers, on average, don't outperform the market, especially after fees. Bogle's research showed this decades ago, and it's still true today. The latest S&P SPIVA report from 2022 found that not a single one of over 2,000 active U.S. equity funds beat the S&P 500 over 5 years. So why pay higher fees for worse results? Passive investing removes the human bias and the guesswork. I'd rather own the whole market at minimal cost than bet on a manager's predictions. 2. It must be truly global. Global means the whole world, not the world minus the UK, or minus fossil fuels, or minus emerging markets. Too many funds tweak their composition to match investor trends, like green energy or AI themes. That's financial fast fashion. I don't want to exclude markets based on current narratives or personal bias. Why? Because human perception is unreliable. A fascinating 2005 neuroscience study showed how people change their own perceptions to align with others, not just their opinions. The study proved that social influence can literally alter how we see things. That's why I avoid tinkering with my core portfolio based on news, sentiment, or emotion. My goal is simple: broad, unfiltered exposure to global markets, including both developed and emerging economies. I'm not trying to predict which regions will win over the next 30 years. 3. It should be in pound. Since I live in the UK, I want my fund priced in pounds to avoid currency conversion fees. It's a small thing, but every fraction of a percent counts over decades. Narrowing down the options using these filters, I shortlisted a few funds that track broad global indices. Most of them follow the FTSE All-World Index, while one tracks the FTSE Global All-Cap Index. The difference: the all-cap version includes small-cap companies, while the all-world sticks to large and mid-caps. Performance-wise, they've been nearly identical over the past 5 years, moving up and down in sync. As my friend Ramin from Pension Craft put it, global index funds have become commoditized. They all do more or less the same thing. So instead of obsessing over the specific index, I focus on cost, accessibility, and tracking accuracy. If a fund's performance chart mirrors its benchmark closely, that's a good sign of reliability. 4. Fees. The real deciding factor here's the main reason I'm changing my investments. Fees. For years, I've held VWRL and VERO, the accumulating version, both tracking the FTSE All-World Index. Their ongoing charges are around 0, 22% 0, 23%, which is already decent for global exposure that includes emerging markets. However, I recently found a cheaper alternative, the Invesco FTSE All-World UCITS ETF, which tracks the exact same index for just 0, 15%. That difference may seem small, but over decades it compounds massively. If you invested £500 a month for 30 years, assuming 8% growth, the lower fee fund would save you roughly £40, 0, in extra fees. For £20, 0 a month, that saving balloons even more. Fees are one of the few things investors can control. So it makes little sense to pay more for an identical product just because of a brand name, even if that brand is Vanguard. Ironically, Vanguard built its reputation on being cheap. I think it's time they cut fees on their global funds again, especially since they offer lower cost equivalents in the US. 5. Risk and practical considerations. The Invesco fund is still small, with around £100 million in assets under management. That's not huge, and small funds come with a few risks, mainly liquidity. Smaller funds can have a wider spread between the buying and selling price. There's also the small risk of closure if it fails to attract enough investors. But Invesco is a massive global provider with $5 trillion under management, so I'm not too worried. As a long-term investor who plans to hold for decades, liquidity isn't a major concern for me. I expect this fund to grow significantly over time as more people notice the lower fees. 6. Platform choice. Platform access also matters. If you invest through Vanguard's own platform, you can only buy Vanguard funds. That's why, while I'll keep my SIP with Vanguard and continue holding the global all-cap fund there, I'll use other platforms for the Invesco ETF. For example, Invest Engine and Trading 212 are currently the cheapest UK platforms for buying ETF within an ISA. Invest Engine even allows limited company investing, so I can invest surplus business cash without withdrawing it. The bigger picture: ultimately, I'm not changing my investing philosophy, just optimizing it. I still believe in global diversification, passive management, and long-term compounding. But now that there's a cheaper, equally reliable option for global exposure, it makes sense to adapt. I'll gradually drip feed into the new Invesco fund, monitor its growth, and potentially shift more of my portfolio once it matures. Hopefully, this move sparks a race to the bottom in fees across UK global ETF. Lower costs benefit everyone, especially long-term investors. And for those wondering, why not just invest in the S&P 500 since it's been the best performer lately? Well, that's a different story entirely.